Welcome to Kitco News. I'm Niels Christensen. Joining me today via Skype is Will Rhind, CEO of GraniteShares. He's here to talk to us about the ongoing liquidity and spread issues in the gold market. Thank you very much for joining us, Will.
Thanks, Niels. Good to be with you.
What's your take on the spreads? I mean, we see this persistent gap between spot and gold futures. What do you think is driving this?
Well, what's driving it, Niels, is that there's a shortage of gold on the COMEX, which is the futures exchange, which obviously backs these contracts, which can be physically settled if they need to be. And you've got these sort of two markets where the main bullion market in the world is in London. That's a 400-ounce bar market. In New York on the COMEX, those are 100-ounce bars. There's two different markets, but right now what's happening with the coronavirus is that it's causing a dislocation kind of in the market, because logistically, the way that gold is transported around the world is on commercial airplanes, and with a lot of the commercial flights, or the majority of commercial flights, not flying, it's been hard to get that gold to where it needs to go, and that's causing this dislocation, and particularly this spread differential or premium between the gold futures prices in New York and the physical 400-ounce bars in London.
So what do you think is going to take to resolve this then? Is it just that we need to see COVID sort of get resolved, or can companies resolve this while dealing with the ongoing pandemic?
Well, it's a combination of two things. So one thing clearly is that because of the pandemic, because of the coronavirus, there's just huge demand for gold. So let's just throw that out there as an obvious point that needs to be made, that we've got this sort of perfect storm where we have huge demand for gold, but we have a supply situation that's being curtailed logistically, at least by the current logistical challenges with airliners and refineries shutting down production, mints shutting down production. So that is kind of causing this double whammy effect where you have a lot of demand, in the market for gold, but yet it's hard to actually furnish that with supply. So all things being equal, getting those gold bars, getting that logistical movement going again, should impact, should help to collapse those spreads, and obviously get the gold moving again.
Do you think there's enough physical to meet the demand that we're seeing? I mean, because that's part of it too, is sort of nobody trusts the paper market, and so I'm sort of wondering, do you think there is enough gold to satisfy the appetite?
I think there is at the moment, but I just want to make clear that I'm saying at the moment because we've had shutdowns, not only at the refinery level, but we started to see it with gold mining companies and mining companies more broadly. And obviously the whole supply chain is no different to the supply chain in many other industries that have been vastly affected by this, where you start with supply at the mine, going to a refinery and then ending up in the market, in the physical market, or at a mint. And so because that supply chain's been impacted, that will have an impact and has had an impact on the price. So I think for now, we're okay in terms of getting supply into the interbank market. I know that many mints have shut down production, so it's been very difficult for people to get gold coins, but that is a different market to the one that we deal in, which is the interbank market, the 400-ounce London bars. So those are okay for the moment, but obviously if there's further impacts from a supply perspective, then that could impact the supply, obviously.
Well, and let's delve into the other side of the paper versus gold argument. How do obviously GraniteShares has bar, which has seen really strong growth, really since its inception. How does the ETF market fit into this supply and demand picture that we see?
Yeah, it's a great question. So when people typically talk about paper gold, what they're talking about is gold futures contracts. So something that is designed, a derivative that's designed to give you exposure to the price of gold, but is not actually gold itself. And that, I think, extends to a lot of other vehicles. So, in the ETF world, the ETF is just an acronym for the word exchange traded fund. And exchange traded funds can take all different types. So, for example, you can have an exchange traded fund, a gold exchange traded fund that's backed by futures contracts. You can have a gold ETF that's backed by gold or holds gold mining shares or even a basket of mixed mining shares. And you can have a gold ETF such as BAR or our gold, GraniteShares Gold Trust, which is backed by actual physical bars of gold. So the difference here is when you're looking to get exposure to gold, then what you're looking to do is hold a ETF that actually gives you exposure to those physical bars. So with BAR, what we are having to do is we got to procure those bars, the 400-ounce physical bars to back those shares in a trust. So literally, the way that it works is the gold trust owns a certain quantity of gold, and we publish the bar list on our website, graniteshares.com, and people can see the serial numbers and what bars that we own. And they are owned directly by the shareholders of the trust. And so one share is roughly equivalent to 100 ounces of gold. And so 100th of an ounce, excuse me. And so that's why you have a share price that's right now about $17 a share. But yeah, we ultimately have to procure the gold from the physical market. And so long as we can do that, we can supply investors with access to the gold market. But obviously, if that supply gets hampered, that would affect, the entire market as well. So it's something that we're looking to do. But I think the main important point when we're looking at paper gold is, make sure that the gold ETF or, the gold exposure that you have is actually physical gold. If that's obviously what you're looking to get, because mining company shares or futures are a different thing.
So enough supply to meet demand for now. What's your outlook for demand? I mean, obviously, a lot of people are talking about making comparisons to 2008, the unprecedented Fed money printing that we saw during the 2008 financial crisis, and now blowing that out of the water. What does that do for prices and demand, do you think? I mean, are we heading to all-time highs?
I think we are, Niels. And, if you think about, what happened in 2008, on the back of 2008, regardless of when you bought gold in 2008, you did very well because the gold price, depending on when you bought, roughly doubled in the next few years and went to an all-time high. And that was on the back of a lot of money printing, unprecedented monetary response, obviously at the time, which now is going to be trumped even more, or has been trumped even more, with the coronavirus. And I think, the recessionary shock is going to be much deeper, and therefore the monetary response is much greater. Now, I mean, U.S. government debt alone is around 17 trillion. With intergovernmental arrangements, et cetera, that's more like 25 trillion. That is just astronomical numbers. And right now, people are looking for, something that, gives them diversification away from a policy of debasement of the currency. The US dollar, we've obviously seen all-time highs in terms of the gold price already, Niels, and other currencies around the world. But for the dollar gold price to make an all-time high, I think if we look back to what happened in 2008, then if that happens again, but even greater, then we almost certainly will see a new all-time high in the gold price sometime, if not this year, then I think next year as well.
Wow, so sort of on the same trajectory, just on a much faster scale then.
Well, I think so, because the conditions are so similar, but they're exaggerated. And this time around, I think one thing that perhaps a lot of people talk to us about is they wonder, why wasn't there this rampant inflation after the financial crisis? I think there's probably one thing which maybe people don't quite appreciate about the conditions post financial crisis, and that was that you had an environment where, from a government policy perspective, you had some austere or austerity type driven programs at the same time as you had this sort of loose monetary policy from the Fed. So although there was money printing, it was into a sort of environment of austerity. which I think curtailed inflation in a way that won't happen this time around. So this time you have the monetary policy response, but you have a very, very sort of proactive, if you want to look at it like that, government that's now going to make sure that
nobody's talking about austerity.
Yeah, this is nobody's talking about austerity right now. This is the absolute opposite. This is trying to save the economy from complete collapse. And so that's what the politicians are working towards. It's why they're handing out checks to everybody individually, to small businesses, to large businesses. So this is an unprecedented monetary response, which I think just extends obviously to gold, and that's why the gold price, in a way, has been doing very well.
Excellent. That's really all the questions I have. I thank you very much for your insights and your outlook on gold. That's it. Yeah, it's hard not to be bullish on gold when you see just the $1 trillion headlines that come across the news wires now. So
yeah, and I think sometimes I get the question, what could go wrong? What's the downside? And it's a tough one to actually answer, believe it or not, because typically the downsides for gold are interest rate rises, which would be the main one, or dollar strength. And at the moment, the dollar strength is only a function of the safe haven demand, which is affecting gold as well. But you have to believe, with all the monetary policy put in place, that I don't think the dollar is strengthening too much from here, and if anything, will weaken over the next couple of years. And then the chances of raising interest rates clearly has to be very, very low this time. And again, this idea of raising rates, I mean, we're down at zero, and if anything, I think rates are going to go lower, not higher. So the downside for gold looks to be very limited at this time.
Do you think we could see negative interest rates in the U.S.? I mean, is that
I don't see why not. Again, we've got the conditions for it, the similar conditions to other parts of the world that have seen negative interest rates. So at the moment, the 10-year is obviously down today as well.
Yeah.
But it just feels to me like interest rates are going lower, and now with interest rates at the zero bound, I think the conditions are the same as they are in Europe, where we have seen negative interest rates. So no reason why they couldn't.
Wow, that's a fantastic way to end it. I thank you very much for your time. That was excellent.
Good to talk to you.
Thank you very much for joining us today. For all your precious metals news, join us at kiko.com.